Want to just kind of update you on what we're talking about today. Louis LaBash, one of our marketers here, is going to be doing a presentation on executive bonus plans, and this really comes as a huge interest right now for not only agents like yourselves but business owners. There's a lot of uncertainty out there in the marketplace as far as what's going to happen to taxes and tax rates, and this is one great way that the business owner can get a deduction for buying his life insurance, as well as building an income tax-free retirement plan. So we're going to show you some real good stuff there. So Louis, I'm going to go ahead, turn this thing over to you, and let you do the business.
Okay, Doug. Hey, good afternoon, everybody. This is Louis LaBash, and today we're going to talk about Section 162 of the Internal Revenue Code. And basically what it is, it essentially stipulates that bonus compensation is tax deductible as a business expense. So the idea behind this is that a company can pay an employee a bonus, and it's a deduction for the company. So they get to deduct the bonus, just like they have to give the employee a 1099 or a W-2, however they pay them the money, but it's a deductible business expense. And we're going to talk about how a corporation can use that same money to buy life insurance to keep the employee in the fold, so to speak. So it's a nice thing about it also is it can be selective and discriminatory. They don't have to buy, if they do this program, they don't have to do it for everybody. Just like they don't have to give everybody a raise, because unless there's some kind of union involved. But if there's no union, if they're just executives that we're talking about, they can indiscriminately give them raises. They can also indiscriminately buy them life insurance. So we're going to talk about how that works. So the idea is this: you have these highly compensated employees, these executives that work for you, and also these are business owners that own their own companies, and they basically, you can throw more money at them, but the money isn't really what they're looking for. They're looking for some opportunity for some retirement income, maybe some security. And the employer, when they do this with the employee, they're trying to tie the employee to the company to make sure they don't get up and leave. And that's the whole concept here. Is it's an executive bonus, but it also has some like golden parachute opportunities built into it. So they basically call them all executive bonus plans, but this is what we're going to use and we're going to talk about today. And then taking that one step further, this executive bonus plan turns into what we call a supplemental employee retirement plan. So the way it works, it's a permanent life insurance policy. It has tax-deferred growth and has built into this thing, because we're going to use the IUL, has annual reset. The employee will own the policy, and if they ever need the money for any reason, they can actually get the money out of the policy, going forward. So it's not like it's tied up in some qualified plan that they can't touch. So they have access to the capital if they need it. And at the end of the day, it provides tax-free retirement income because we're going to structure the policy correctly in order to do that. And so the whole idea behind this thing is that one of the big pieces that most people don't talk about and don't understand is that these index universal life products have this thing called arbitrage opportunities. And what that means is that when you take the money out of an index universal life, when you borrow the money out, if you have the right product, when they have variable loan rates, and when they borrow the money out, the money still gets to earn whatever the market does. So basically the idea being behind this is that, as example, last year, everybody that had a North American product that had their money tied to the S&P 500, and the product they had last year had a 14% cap. If they borrowed the money out to go buy a boat, to go gambling, to pay the electric bill, they took the money out, they had to pay 4% interest to borrow the money out. But that same money still earned 14% because the cap was 14% and the market was up 14%. So all the money they took out, they actually earned 10% on it above what they paid for it. So the idea behind this is that there is no other product in the marketplace that you can take your money out, go buy a boat, go gamble with it, pay the electric bill, buy food, do whatever you want with the money, and have it still earn you money. And that's one of the real strengths of this thing. We're going to talk about that some more. So what's in this for the business owner, basically? Well, first of all, they get to retain their valuable employees. They help the employees have this business knowledge that's kind of hard to replace. I've been in this in the corporate world in the past, and I've gotten promoted to a job where I walk into the office, and the person who basically had the position before me took 15 minutes to tell me everything that had to be done and went off about did his own little thing on his new job. Well, at least I got 15 minutes. In most cases, if somebody leaves, not by promotion, but just leaves, you lose all that knowledge. And they very rarely pass anything on. Matter of fact, when they leave, they also maybe take all their customers with them as well. So this is one way to retain valuable employees. Make sure you keep your customer base. Also makes it, everything more reliable for your business and for your company. Keeps your customers happy. They don't like to have round robin changes of contact people at businesses. They like to have the same person, the go-to person they can go to all the time. They don't want to learn new people, new nuances about how to do business with them. So it helps your business with that part of it. Also, there's internal continuity that is built in this thing because the employees have to work together. And when you get a new guy on the team or a new gal on the team, maybe you don't click as easily or don't understand some of the communication things that need to be done, and that causes some problems as far as making sure everything just kind of runs smoothly. So the whole idea behind this is if you keep your employees in place, it enhances productivity. Also, it's a tax-deductible business expense to do this. So, and the plan can be designed and customized for each executive. So you can set this up to keep the most valuable people on board, the ones that aren't as valuable, the ones that maybe you don't even want to keep around. You don't give them a program. So the idea behind this is that you can, as a business owner, design this program to make your business as effective as possible with the employees or the human capital that you have working for you that day. Right? And the administration cost of this is pretty simple. They have to buy a stamp to write the check, send off the check. The insurance company takes care of all the administration. So basically, they don't have to hire some special organization, some TPA to come in and take care of everything. No administration costs. Cost them a stamp. So how does it work? Essentially, a couple ways you can do this. The executive actually owns the policy. The company pays the premium. They can pay it directly to the insurance company, and the executive owns the policy. And that's one simple way to do it. Or the company pays the premium to the executive, and the executive pays it to the insurance company. From an insurance agent point of view, you would probably want it to be the first way. And also, if you're the company, you would probably want to do it the first way, the top one, because the company wants to make sure the money's going to the insurance policy to retain the employee. You want to make sure the money's going to the insurance policy to an insurance company to make sure the policy stays in force. So this might be your more favorite way, but it works in either way. Either way you want to do this. But it's pretty simple as that. The company pays a premium, and the insurance company gets the money. The executive has the policy. Simple as that. Going forward. So what's in it for the employee? All right. First of all, they get family security. They get more insurance. It's part of the program. Insurance is included in the whole deal. All right. They might get more a feeling of appreciation if they're picked out and as one of the key executives that get these programs. So that's accolades for them. Also, it provides them with higher income. Out of the box, they actually have higher income. They have more money. They end up getting more money ultimately out of this company for the things that they do. And they end up with a supplemental employee retirement program that basically can cost the employee as little as $0 to do this. And essentially the way that works is this, is that when the company provides a bonus to somebody, the bonus is a taxable event as taxable income to the employee. So say the employee is in a 28% tax bracket and he gets this $10,000 bonus. Well, the employer gets a tax deduction, and say most corporate employers are at a 39% tax bracket. Okay, so they save 39% in taxes. Basically, the employee has to pay taxes on the 10,000, which is 28% of that. So basically, if they pay the premium, $10,000 to the insurance company, the tax on that is $2,800. If they did a single bonus to the employee, what that means is that the company is going to bonus the employee $1,280 totally. That's what's going to be a 1099 for it. $10,000 goes to the insurance company, $2,800 to the employee, which this $2,800 is destined for Uncle Sam. And basically, after tax, it costs the employer $7,800 for this program. And because it was a single bonus, the employee does have to pay the tax on this program, and it costs them $1,000 in taxes. Okay, But then you can actually do a double bonus, which means that we're going to give the employee enough money to pay the taxes on both the premium as well as the tax on the bonus. So that way that works out is that the premium is $10,000, the tax is $3,800. So they give the employee $13,889, and the employee, it costs them nothing after tax. And this little calculator I built, basically, if we did $30,000, you'll see how everything works out. Just does all the numbers, everything changes, but essentially it does the calculations for you very simply. So again, at the end of the day, the employee can pay as little as nothing. Again, the more they pay them, the more tax is required, but if they bonus them, it ends up being nothing. So it just calculates it for them very simply. So the idea behind this is that it could cost the employee zero after tax, and then basically if it's, if the employee is a, major owner of the corporation and he's bonusing himself, he probably doesn't want to pay the taxes anyway, so let the corporation pay it for him. So that's the idea behind this. So going forward, what it does for both of them, it promotes their partnership, make sure that they're more of a team, enhances productivity, promotes employee job satisfaction, and at the same time it will provide what I call the best retirement program of the 21st century. And we're going to show you how that works, okay? So that's how you find the money. So essentially what we're trying to do here is explain that the corporation can pay for all this, get a tax deduction for doing it. Now, because that happened, there are some other ramifications in there, and the employee is going to get some, taxable events going to happen to them, but if it's done correctly, it will cost them nothing, or little, basically. Little or nothing, just depending on how you set it up. So now we found the money, what are we going to do with the money, okay? Well, first of all, what we're going to do is we're going to purchase a max-funded index universal life policy. Simple as that. We're going to purchase the least amount of coverage for the most amount of money. And some of you who have sold universal life in the past, and some of you have this fond memory or not so fond memory of how those policies have all blown up, a lot of them in the past. It's and the reason for that is that the way those policies were sold is that when universal life first came out, the interest rates were, current interest rates were somewhere in the neighborhood of 10, 12%, depending on the policy that you were selling. And everybody was going out and showing 10, 12% is what it was going to earn going forward. And based on the 10, 12%, to buy, say, $100,000 of insurance, you only had to pay $200 a year. So whatever's the lowest number. So they sold the most amount of insurance for the least amount of premium because they used the 10 to 12% return that the policy was going to pay to make sure that it would all work. Well, unfortunately, the 10 to 12% didn't last very long, and then nobody went back and told anybody, oh, by the way, now that the interest rates have dropped down to 4%, you're going to have to put in a whole bunch more money to keep this policy in force. So what happened, essentially, a lot of those policies got in trouble. People didn't put any more money into them. Nobody told them to put any more money into them. And at the end of the day, everybody looks back at them and said, boy, those policies were terrible. And really, they weren't so bad. It's just that the way they were sold. And the concept here was that they sold the most amount of insurance for the least amount of money. What we're going to do is we're going to sell the least amount of insurance for the most amount of money. Completely opposite the way this works. And that makes sure that this is going to succeed.